Hello everyone, greeting from China, Wuhan. My name is Zheng Siyuan. I'm studying at Zhongnan University of Economic and Law. Today is my debut at academic conference. Thanks for having me here. And I will share my research on psychological anchors and stock return predictability. I'll follow this outline. After background and motivation, I will briefly review the literature and then focus on my research design. Finally, I will summarize conclusions and innovation of my research. Well, as a psychological concept, anchoring effect came from an experiment in 1974. Two scholars found that the numbers people guessed by playing the turntable would consciously close to the given initially value, just like approaching an anchor. Later, this concept is being used in behavior finance. As for my motivation, is that characteristic of China's stock market may stronger than the anchoring effect. In China, there are far more individual investors than institutional investors, and the information disclosure mechanism is relatively weak. Even worse, the anchoring effect means a negative feedback mechanism. Because of information asymmetry, you look for an anchor, and then because of this anchor, you have more information bias. Now, interested in these questions, I read some articles. It can be seen that whether in foreigner countries or in China, literature can be roughly divided into two parts about the attribution or about phenomena related to anchoring effect like IPO. I find it interesting, like number worship. Chinese people don't like 4 and we like 8. So those stocks with many 8 in that code may be more popular. And my topic is psychological anchor and its ability to predict future returns. Now I will introduce my ideas. We know that the new high of stock prices is a conference point, and media often pay more attention to 52-week highs and historical highs. When the stock prices gradually approach the new high, there always will be two kinds of traders in the market. Some traders may pay too much attention, which means overreact to the reference point, and other traders may be too conservative, that is, underreact to this reference point. So I get the first pair of hypotheses. Investors may overreact or underreact to the 52-week highs or historical highs. So it brings us to the mechanism that how anchors affect the future returns. If investors overreact, overtrading will bring excess returns in the short time, but it will fall back to its true value in the long term. Therefore, the nearness to the anchor may be a negative predictor. As for underreacting, the opposite is true. So this is my second pair of hypotheses. If an investor do take 52-week highs or historical highs as anchors, then the nearest to the anchor may be a predictor. So I choose the Asia data from January 2003 to December 2017, which is divided into two parts, the index and monthly data of all company. As for variables like excess returns, and the nearest to the anchor is the ratio of the stock price to its anchor in each period. And also to dummy variables whether it has reached any high point. And at last we have some other controls variables. Well, this is descriptive statistics. In the end, there are more than 2,400 companies and a total of 168 months of data. And then it can be seen that only the correlation coefficient of two anchors is relatively high, and I pay attention to it during the later regression of price. Then I need to verify whether there is overreaction or underreaction in the market. This is one of the innovation of my research. I refer to the CAR model to set former 52 weeks as the formation period and later 52 weeks as a probative period, according to a ratio of current price to the corresponding high point. During the formation period, the stocks was delivered into 10 groups. The group with the higher risk ratios is the winner, with the lowest is loser. Then I calculate the annual excess return of each group during the profited period, and I call it CAR. Then I repeat 14 times on the timeline. Our strategy is to buy the winners and sell the losers. If the CAR of the winner is positive and the loser's CAR is negative, and our profit of the strategy is negative, it means that the winner in the previous 52 weeks still have excess returns in the next 52 weeks. So at this time, investor has underestimated these stocks, that is underreaction. Similarly, if the sign is opposite, it means overreaction. So what's the result? As you can see in this table, when we consider the 52-week high as an anchor, we find that in most cases, the CR of winners is positive and the CR of losers is negative. So investors clearly underreact around the 52-week high points. But for historical highs, you can see that no stable heckling effect has been found. Then I regress future excess return onto corresponding past returns within 1 month to 1 year. This step refers to the article I listed here, and I will explain the difference at the end. But now we have the conclusion that the 52-week anchor can be used as a positive predictor, but historical highs cannot. Then, using individual data, I did similar work and the results are shown here. In short, they are still consistent with the conclusions obtained by using the index in the previous part. Okay, for this part, robustness, I will directly tell you the conclusion. Firstly, I proved that the difference between portfolios grouped by the anchor can be hardly explained by the campaign model or the farmer and friends refactor model, so it is necessary using CAR. Then I excluded the seasonal effect. In addition to the January effect, I also paid a special attention to February, because February includes our Spring Festival. But you can see the results are still stable. The last three tables are all related to behavioral characteristics. The first one shows that portfolios based on original transaction price are more profitable. In line with what we said at the very beginning, the initial value is more likely to be used as an anchor. In this table, if you were an investor, you will be impressed with high points. Those have not been broken for a long time, and you are more likely to use them as anchors. And in this table, you will hardly use the high points from a small company as anchors because of their high turnover and volatility, make you think they're too speculative. So now let me summarize my conclusion. Firstly, the psychological anchoring fact doesn't exist in Chinese share market. And then I use two kinds of data. My conclusion is that investors underreact to 52 weak high points, and the nearest to the anchor is a positive predictor, but there is no obvious anchoring fact around the historical highs. Those conclusions are relatively robust. Finally, let me summarize the contribution of my research. On the one hand, I paired the internal relation between the anchors and excess return in the future. So I refer to CAR model and compare the returns between winners and losers to verify the existence of underreaction. Only after that I can explain the correlation from the perspective of behavioral bias. But peer-reviewed literature has not given empirical evidence for this. They always use good news to explain, but there is no definition of often, no definition for consistently, or even for the good news itself. They haven't verified whether such an mechanism meets the preconditions of the model they have referred to, but they directly use over reaction or underreaction to explain this correlation. So I think my method avoid this problem, and this is more suitable for studying the Chinese market too. On the other hand, I consider other behavioral characteristics. Well, these are my presentations. I'm looking forward to communicating with you online. Thank you.